What's going on, guys? Welcome back to the channel. My name is Mark and this is Entrepreneurial Finance. Okay, so what we're going to talk about today is my favorite oil stock that you can buy right now, and boy oh boy has oil or energy in general been making some news lately. About a week or so ago, oil futures set to be delivered in May actually went negative and dropped about 300% in one day. This isn't your typical financial asset that you can just buy and get rid of on any given day. This is a standardized derivative contract where the buyer is actually obligated to purchase the asset at a given price at a certain expiration date. So when you have people actually purchasing these contracts, you have people actually buying the delivery of oil to their house. Rest in peace to everybody in this Reddit thread that actually ended up trying to make a spread on these oil futures and are now set to get thousands and thousands of barrels of oil delivered to their house in May. Okay, so that being said, guys, we're going to review the macroeconomic environment of energy currently. We're going to look at some of the most dominant North American energy companies, and ultimately I'm going to give you my recommendation as to which one I would purchase if I wanted to get exposure to North American oil right now. So please note, this is not investing advice, it's simply my own opinion, and this video is meant for informative purposes only. Please always remember to assess your own risk tolerance as well as formulate your own opinions before putting your money at risk. That being said, guys, let's go ahead and get into the video. Okay, so just looking at the current macroeconomic environment, there's no surprise that there is currently a supply glut in the oil industry. Supply and demand are pretty much the main two factors that you want to consider when investing in oil here. As most of the world remains on lockdown measures, people are traveling less, whether that be via car, via airplane, or by boat. So basically, vehicle fuel demand is slowing. At the same time, some of the major oil producers worldwide, such as the United States, Saudi Arabia, and Russia, have actually been increasing production. And they have been really for a long time now. So what you have is you have slowing demand and you have increased supply, which results in nothing but decreased prices. This is quite possibly the worst case scenario for energy. What you always need to be cognizant of with energy is OPEC. So OPEC is the Organized Petroleum Exporting Countries, and you need to kind of think of them as a cartel or the police of the oil industry. Okay, what they do is they provide policies and attempt to regulate the price of oil worldwide so that all major oil producers and countries can benefit. So the whole COVID situation has no doubt been a massive demand shock to this industry, but what has even made it worse is the rebellious behavior of Russia. When they were unable to come to a deal on production quotas, the price of oil actually tanked. Since that time, in about mid-March, they've actually agreed to a production quota, as no major oligarchs worldwide are really going to benefit from lower prices. Which kind of brings this point to speculation, was Russia or Saudi Arabia attempting to squeeze North American oil? Because they wouldn't benefit from lower prices, but they would benefit from an increased market share. And what's the best way to do that? By squeezing other major oil producers worldwide. You can see in this graph that Saudi Arabia and Russia have a much lower cost of producing a barrel of oil than the US and Canada. If Russia was able to squeeze out some of the US shale producers, it would allow for other players to potentially steal that market share from them. The marginal cost of producing a barrel of oil is actually extremely important in this case. Now, something that I also want to talk about is contango, and contango is a technical term used when the futures price of a commodity is trading higher than the spot price of a commodity, also known as forwardation. This generally happens when the price of the asset is expected to rise over time. What we're seeing with oil markets right now is that people are willing to pay a premium to buy oil in the future instead of buy it cheaply now and store it or incur the cost of carry, because storage costs are actually extremely high. At the end of the day, there's a lot of experienced investors that trade options and stuff and benefit greatly from arbitrage strategies via contango. I highly encourage you to look them up. This is not something that I've personally taken advantage of in my investing strategies. Now, the next question is, what is the demand outlook for oil? We know that demand saw this huge shock because nobody's traveling right now, everybody's on lockdown, but COVID kind of creates this uncertainty for the future demand outlook of energy, actually. Ultimately, the demand for oil relies on governments lifting these lockdown sanctions and how quickly economic activity can resume. So despite the current market challenges, the International Energy Agency actually expects oil demand to increase at an average annual rate of 1 million barrels per day. I think this is very optimistic given that consumer behavior is likely to change greatly when lockdown sanctions are lifted. I'm not saying that everybody is so fearful that there will be absolutely no recreational travel at all, but certainly people will probably think about taking advantage of cheap flights to international destinations, at least for about a year or 6 months or so. That's just my opinion. On top of a murky demand outlook, the International Energy Agency actually states that the oil market is comfortably supplied through 2025, even with 3.5 million barrels a day of production lost from the likes of Iran, Libya, and Venezuela. There's also the question about renewable energy. Just look at how well the Tesla stock has done this year. Now, I'm no renewable energy expert, but I do feel that the Gen Z and millennial cohorts of the population are extremely attracted to healthier or in more environmentally and socially friendly alternatives. I'm not just talking about fossil fuels here, I'm talking just in general. As time passes and continues to go on here, we only get more educated about how to live healthier lives as well as how to preserve our planet. I'm not going to go full tree hugger here, but renewable energy certainly is a threat to replace fossil fuel alternatives in the future, as we will run out of oil one day. Specifically, hydro, wind, solar, and biomass are the biggest threats to take over fossil fuel alternatives at this point. So China is currently a leader in this matter and produces 15% of the world's renewable energy. And you can also see here that Canada's main source of renewable energy is hydro, and it currently represents just below 70% of our renewable capacity. Okay guys, now that we've kind of talked about the macroeconomic environment of energy, let's go ahead and move on to some of the major companies in this industry, and we're going to look at some of the technicals, we're going to look at some of the fundamentals, and ultimately give you guys a recommendation about what my favorite company is at the end of this video. So these are the major energy producers in North America. So you have ExxonMobil, you have Chevron, we have Royal Dutch Shell, Total, BP, ConocoPhillips, Valero Energy, Marathon Petroleum, as well as Occidental Petroleum. A couple things that I looked at here was which stocks have actually lost the most value year to date and that you could potentially scoop up at discounts. I looked at things such as who pays the best dividend, who has the highest EPS, the best price to earnings, the best price to book, price to sales, the best EV to EBITDA, and ultimately looking at some of their financials to try and help you guys determine which is the best company to invest in here. If you look at all these companies, the one with the largest market cap is actually ExxonMobil. If you're an income investor and you're looking at who's likely paying the best dividend in the future, you probably want to look at Royal Dutch Shell. Now, they actually just announced today that they're going to be cutting their dividend. ConocoPhillips actually has the highest earnings per share. The best price to earnings ratio is Marathon Petroleum. The best price to book is Occidental Petroleum. The best price to sales is Marathon Petroleum. And then the best EV to EBITDA ratio is ConocoPhillips. Another thing you probably want to look at is the current ratio here. Since the demand outlook is pretty uncertain for at least the next 12 months, the current ratio gives you an idea of which companies will be able to fulfill their short-term obligations with their current cash. ConocoPhillips actually has the best current ratio right now, and they're probably one of my favorite companies in this competitors table. Okay, so after kind of looking through the financials of most of these companies, it's pretty clear to me that there is one that kind of stands out, as well as what their management is doing moving forward through this pandemic. And to me, that's ConocoPhillips. Ultimately, what I like about ConocoPhillips is their strong balance sheet. They have a extremely high current ratio of 2.4, whereas most of the other companies sit around 1.2 in that range. And like I said, having a strong current ratio due to the current market conditions is going to benefit them greatly. There's not really a risk of bankruptcy here in the short term. Another important factor is that they've continually reduced their debt throughout the years, and that puts them in a great spot relative to their peers. If you can see here, ExxonMobil has over $20 billion in current debt, whereas ConocoPhillips only has $100 million. If you look at the long-term debt, that situation is a little bit different, but if you're looking at maturities within the next 12 months, think about ExxonMobil having to pay $20 billion back, whereas ConocoPhillips only having to pay $100 million back. That's a factor of almost 20. That's insane. On top of that, management has made a conceited effort to cut costs in current market conditions. So they've lowered their capex forecast by $700 million. They lowered their production output by approximately 20k barrels a day, and they're reducing their share buyback plan. All in, this has saved them about $2.2 billion in cash for the current year. Also, if you ever need any validation on this analysis, Conoco is actually highly recommended by the analyst agency here. The price target isn't very high, but they're not long off their all-time high of $75, which would provide a little under 100% upside if they're able to recover and ultimately hit that all-time high again. That being said, I think the macro outlook for energy is pretty gloomy. I would be pretty cautious if you're looking to invest in this industry. It may look attractive from a value standpoint, but if there's one thing that I can tell you or share with you from my experience, it's that capital markets attracts the best of talent. You always need to operate like the markets know more than you, because the matter of the fact is they do. Okay, so that's all I have for the video, guys. I hope you guys did enjoy. If you did enjoy, let me know what you think about the energy outlook in the comments. Share the video with a friend if you learned something, and don't forget to like and subscribe to the channel. Okay, guys, I will see you guys in the next video. Peace out.